It's the moment investors around the world wait for, the 9:30 opening of the U.S. markets. Inside Citadel's Chicago headquarters, it's eerily quiet, even though this firm trades more stocks every day than the New York Stock Exchange.
Now, 2 minutes to the open, so we're about to get going here. I have a world clock up there. That's about it. We're just going to hear the air conditioning above us. How do the books look, guys? So we're pumping through a lot of volume right now. You can see how quiet it is. The phone's not even ringing. Clients are happy. If there was ever an issue, obviously we would spot it first and the phones would light up.
The equivalent of the NYSE's opening bell is just this. Millions of orders that have been waiting all night for the markets to open are rapidly filled by Citadel's computer programs.
We have executed 21 million shares already.
Wow, and we are not even 3 minutes in. When you click send from your TD Ameritrade account, there's a good chance that Citadel's computers see it. Then they either fill your order or send it out to the Byzantine network of 13 exchanges and 20 plus dark pools to execute it.
Dark pool is really, it's an unfortunate terminology that the industry created, and really a dark pool is nothing more than a crossing engine. Now it's called dark because the whole market doesn't know what you want to buy or sell.
So while the retail trader will get the best price in the market, there's nothing to show that that is an accurate price. It exists for two reasons. The first reason is price discovery, and the second is capital formation. That's it. The market is not there to be a casino for math geniuses. The price discovery mechanism breaks down when too much of the incoming orders are executed outside of the normal exchange system. And there have been several studies that have demonstrated that at the 40% mark, it acts as a disincentive for people to post orders on the marketplace. We are right at the 40% threshold now for volume that is happening off exchange.
This business appears to be lucrative for Citadel. Its founder and CEO, Kenneth Griffin, made $900 million last year, according to Institutional Investor. Here, in their Chicago offices, they say they execute 14% of all stocks traded in the United States.
They are not making trading decisions. Those are all made by the computers.
Essentially, they pay to see the orders that you make online first and decide whether or not to take the other side of that trade. If the algorithm likes the price, they play ball. If it doesn't, Citadel passes the trade on to an exchange.
The first reason is price discovery, and the second is capital formation. That's it. The market is not there to be a casino for math geniuses. The price discovery mechanism breaks down when too much of the incoming orders are executed outside of the normal exchange system. And there have been several studies that have demonstrated that at the 40% mark, it acts as a disincentive for people to post orders on the marketplace. You can reap some of the benefits of high-speed trading systems, but it's a very questionable claim. As soon as you've looked at something and clicked, or typed in something and clicked, the benefits don't accrue to you because you've already taken hundreds of milliseconds to take an action, and that's just an eternity in the world of high-frequency trading.
You used to have literally thousands and thousands of traders that do the job that our couple dozen people do every day.
I don't believe that's true, because not every person on the New York Stock Exchange trading floor was a PhD in climate science from Harvard. Yet everyone at these HFT firms are the best of the best.
That's a panel that shows the state of our infrastructure.
Fast-paced world of high-speed trading, where millions of shares change hands in seconds, the offices of TradeWorks in Red Bank, New Jersey are surprisingly laid back, a place where a handful of young programmers work on complex trading strategies. On the second floor of this building is a high-frequency trading firm, one of the few that will talk to the press.
What's happening in the financial industry is happening all over the economy. Technology is wreaking havoc with traditional business models. The way that happens is technology comes in and plays a role in reducing the cost and increasing the efficiency of services that are delivered to the public. This is an actual trade that we participate in, which is a moneymaker for us.
But founder Minaj Narang says nothing could be further from the truth.
The thing about high-frequency traders in particular is that their buying interest in any fixed time period generally is exactly identical to their selling interest. Meaning,
so you're doing both?
Meaning we buy as many shares as we sell in relatively short time periods. So it's fairly easy to, just as a thought experiment, see that high-frequency traders cannot impact the prices of stocks.
Why do you think that the attention keeps coming back to high-frequency trading if what you say is true?
What you see in the financial industry is that lots and lots of firms, the asset management industry in particular, multi-trillion-dollar industry, is under pressure because managers habitually underperform their benchmarks.
So a bit of sour grapes.
It's sour grapes because, look, it's the oldest trick on Wall Street to look for a scapegoat when you can't explain your own performance, right? It's always the case that everyone who's wrong thinks that they're right, but the market is wrong. The flash crash really was a peculiar case. Technology definitely played a role in the flash crash, but technology should not connote or imply high-frequency trading. They're two completely separate things. The vast majority of trades that are executed today by all kinds of players, whether they're algorithmic traders or not, are executed by computer.